Hi, and welcome to Sunday Night Charts. We take a look at the charts to help you with the trading week ahead. I'm your host, Steve Van Meter, and today's show is really mostly about the dollar and its relationship to the broad equity markets. Let's get this kicked off. We got the trend indicators. Short term, 9 days. Intermediate term, 21 days. Long term is 50. Ultra long term, 100. Moving averages. These are the colors on my screen. The 50 days green, 100 days blue, 200 days tan. Moving on, price versus momentum. Price is the general direction prices are headed. Momentum is a rate of change. A bullish indicator for both is positive and a bearish indicator for both is negative. Momentum often, but not always, leads price. Technical analysis attempts to determine where buyers and sellers are at. Resistance is a level buyers can't break, and support is a level sellers can't break, or resistance is where sellers are at, and support is where buyers are at. Keep in mind, technical analysis does not predict prices. It can be used to determine the risk of a trade, help with timing a trade, and provide direction to the path of least resistance. Charting offers possibilities and not probabilities, and not certainties. Let's get into the S&P 500, where really the only change, it was bullish across the board. We see on the 100-day, we're still a little bearish flat signal there. Otherwise, bullish across the board. Let's take a look at the price charts. Now, I've added this red line. This is the dollars, trade-weighted dollar symbol, DXY. And you can see one of the problems with technical analysis is when you zoom out and you're at all-time highs, there's nothing to compare it to. It's up there, and the only thing you have is blue sky ahead. So the question is, where are the sellers going to be at? Are there going to be sellers? Some of you are shaking your head. Nope, this thing's going up, up, and up. And really what you see here is the equity market, as I hold my mouse over the trade-weighted dollar, is just a short dollar trade. So you can go back to March and say, if you're long equities, you're betting on a weaker dollar, and you're betting on a perpetually weaker dollar. So if you're bearish on the dollar, you should be bullish on equities. Let's take a look at the Nasdaq, see what's going on over there. Again, no real change here on the longer, ultra long term, still bearish. Effectively no change. You're going to see a lot of this in today's data. No real change there. Let's flip over to the Nasdaq, and tech stocks, they're slightly above their all-time high. I don't know if you want to call this a double top. It's too close to say, but look at this from the perspective of the dollar. Again, weak dollar, high equity prices, people buying equities at these points and have been holding equities, understand they're overpaying. From a multiple perspective, you see massive multiple expansion. PE ratios are very high. What you're betting on is simply a weaker dollar. You get a counter rally in the dollar, equity prices are going to go down. Let's look at the Russell 2000. No change on the Russell's picture. On the short-term, momentum remains bearish, but otherwise no real change there. Let's take a look at the Russell, which of course, again, is a short dollar trade. It's very clearly a short dollar trade, as the Russell is also at all-time highs. Everything is pretty much at all-time highs, strictly on the basis that the dollar is going down and possibly lower. We'll take a look at, when we get to the dollar, what's going on with it. How about the VIX? Many of you have asked for us to look at the VIX, so I'm going to remove this dollar momentarily. And what you see is the VIX is pretty much sitting back where it was in August. So no real change here. The equity bulls would love to see the VIX all the way down here in the teens. As far as they are concerned, weaker dollar, lower VIX. This is just a recipe for a blow off top in the equity markets. Maybe it is, maybe it isn't, but there's your look at the VIX. How about the energy sector? No real change here. I flip on the ultra long term on momentum to bullish. It wasn't long ago that no one wanted energy, and now they think energy prices are going to skyrocket again. If we go back and overlay this with the dollar, you can see this is, again, mostly a dollar trade. And I'll change this over back to red, make it a little easier to see, at least for me, so hopefully for you. And you can see that now that the dollar is going down, at least back since late October, now the energy market is actually responding to the weaker dollar. Again, energy market it's not from a demand perspective we're seeing things rally. We're seeing it from a weaker dollar perspective. And as you can imagine, the financial sector is unchanged as well. And is it a weak dollar trade? Yes, it is. Pretty much everything here now is a weak dollar trade. And you can see they're nicely inversely correlated. Not perfectly, but pretty darn close, telling you that financial stocks are rising, not because banks are making more money on loans or anything like that, not because of economic outlook, simply because of a weaker dollar. And if you missed out on the Friday macro show, I highly encourage you to go back and watch that, where we talk a whole lot about the dollar. Utility sector, well, here's a few changes on the momentum. Utilities turn bullish, otherwise no change on utilities. Let's take a quick look at the XLU. I know we don't normally look at it, but don't have a lot to talk about in terms of support and resistance levels. And you can see it's not responding as much to the weaker dollar. It was, but now it's starting to look a little toppish here as the utility sector potentially looks to head lower. How about the industrials? Again, no change. I mean, you're going to see almost no change. Maybe one, maybe two at the most on these things, but no real change here on industrials. This is bullish, and it should be bullish because industrials are a trade on the weak dollar. Where are you, industrials? XLI. Here you are. There you go. Overlay the dollar, and what do you have? Industrials are rising because of the weaker dollar trade. Let's go on to the gold miners. Everybody is bullish on gold, but for some reason, gold isn't responding that much to the dollar. Short-term indicators flip to bullish. Intermediate term on the momentum flip to bullish. Remains bearish otherwise. Let's take a look at what's going on with the GDX. And, this is something you would expect to be, higher because of the weaker dollar. But it's something this is interesting, as I pointed out in the Friday show, that, something isn't adding up here, because if the dollar's going down and gold's going down, it tells you there is something wrong in the system. I did update what still looks to be a bullish flag. Remember, we had the flagpole going up and a very long bullish flag that almost broke down below. GDX is sitting below its 200-day moving average. A lot of traders don't tend to like anything below the 200-day moving average. But if the dollar is a sign that GDX can't go up as the dollar's going down, well, what's going to happen to GDX should the dollar rise? I know some of you are saying that is not going to happen anytime soon. Maybe it won't. Maybe it will. How about emerging markets? No change here. This is purely a weak dollar trade. And I want to spend a little time on EEM because there's something interesting going on here. And you can see, this is exactly a weak dollar trade. Emerging market stocks, love a weaker dollar. But let's zoom out to the max weekly on the chart, and I'll just keep my mouse over this. And what you can see on the EEM, it's sitting right back where it was at its highs in January of 2018, slightly above its highs in May 2011, almost back at its May 2008 highs, and almost back. Of course, the high was back in 2007 before this thing crashed. So you see emerging market stocks are massively stretched against the weaker dollar. And what's notable is the dollar is actually not all that weak compared to where emerging market stocks were. So some people are looking at this and saying this is super bullish for emerging market stocks if the dollar can keep going lower. That would be. The other side is maybe this is as far as emerging market stocks are about to go, and it's signaling a potential trend change in EEM. Could be bets on either side of that one. Looking at long-term Treasury bonds, I know most of you pretty much are bearish on bonds, bullish on higher interest rates. And you can see this has gone back to complete red, as bonds are probably one of the, if not the most hated trade in the market right now. And let's zoom in, because what is a weaker dollar telling you? That bond prices should be going down. You'll notice there's the general relationship between the dollar and bond prices is that as the dollar goes down, bond prices should too. But yet there's something interesting. Bond prices keep holding up here, and that doesn't make a lot of sense to many people. Let me remove this so we can see this a little bit easier. What we have is support. Once again, in the last 6 months, support back in June. We have support again here in November, and we have support early December at the same price level, which is approximately on the 30-year right in the mid to low 1.7% range, where thou has not broken. Now, what's interesting about this is you have to have lending demand. This is why in the Friday macro show, we go through the H.8 data, because what this is telling you is even as the dollar is going lower, interest rates aren't going higher, bonds aren't going lower, meaning if there is a reversal in the dollar, and there likely will be at some point. I know, again, most of you are shaking your heads, no way, dollar, it is toast, it is going to zero and maybe negative. when the dollar reverses, remember, bonds are just a long dollar trade. So that makes perfect sense that if you're bearish on the dollar, you should be bearish on bonds. Keep in mind, though, if this gets going, it will pull the dollar back higher. But so far, you've got massive amount of selling here, and you still can't break 1.725% on the 30 years, 1.75. Can't break it. No lending demand. And on we go to high yield bonds. Now, we did see a few flips, but this is bullish. It would make sense because what are high yield bonds? They're a proxy of equity prices. So you would want to see that high yield bonds are going to go higher as stock prices go higher. And we can overlay the broad equity market. If we clicked on the right spot, would be a big help. And here you go. You can see over the last, say, 1 year that high yield bonds tend to follow equity prices higher. Now, what's frightening about this is people are paying a big premium in the high yield space to own these, and they're not getting much yield in return. If we look back, and you can see they're pretty much running into resistance right at near their 2-year highs here. From a yield perspective, if you are buying high yield bonds, where is that? You are taking a lot of risk for a 4.72% yield. There is a massive amount of risk in this space, and yet investors are unconcerned about it. Let's move on to gold futures, kind of like bond people. I understand where you gold bulls are at. I feel your pain. I know what it's like to be bullish on something. Everybody says no, but look at what's going on in gold, bearish almost across the board. Let's take a look at gold futures and see what we've got going on. We did find some support here, right between this 1800 and 1825 or 1820 level. And now it's starting to find resistance back where it was at 1850. The question is this going to be a bottom for gold and new all-time highs? And I know many of you are shaking your head yes, or just roll over and head lower. Again, the dollar, says gold should be a lot higher. How about silver? A little bit better picture on silver. We have some bullish momentum triggers on the short and intermediate term, long-term flipped on price to bullish. But let's take a look at silver. Remember, I said silver was probably headed lower, and it's still not there. I think silver's got a lot of ways to go to get down. I really do believe it can get down to this $18 price level pretty easily, and it's back looking at resistance here in the $24.50 to $25 price level where there's been sellers in the past. This is a pretty risky place for silver, looking like a topping pattern because you're seeing lower highs. And you see kind of a baseline here that if silver is going to get a break below, say, $22 to $23 again, you're risking the floor coming out and heading down to this $18 price range on silver. What do we have next? I need to flip the screen so you can see it. There it is. Okay, the dollar. Of course. There you go. Hey, everybody's cheering now. Get that dollar down. Lower, lower, lower. Dollar goes to zero. Bearish across the board on the dollar. And what do we have here? We almost had we talked about what a Wyckoff bottom looks like. Remember, if you're trading patterns, right, you have to wait till it breaks, through. In this case, it broke below. Many of you were very happy about that. Made sure that I knew about it, as you were reminding me how wrong I was. Do keep in mind, I don't trade currencies. And down here, you see that the first level of resistance for the dollar is right around $90.40 on the trade-weighted dollar, where you see that nice level of resistance. Many people do think it's going to get into the 88 to the 89s. It absolutely can. That was where this prior bottom was going back to, say, March of 2018. Keep this in mind. March of 2018 signaled near-term top of emerging markets. So potential opportunities depending on whether you're bullish on the dollar or bearish. Maybe you think it's going to go even lower. Maybe you think the dollar is going to break through this 88 and going to get down into the mid to low 80s. Maybe it does. I don't think it does, but hey, I know many are saying you're always wrong. Okay, well, there you go. So let's look at Bitcoin, and then we'll wrap up today's show, which is always, boy, it is a short dollar trade as well. Let's overlay the trade weighted dollar change the color here to red so you can see it. And make sure we're on. Okay, there we go. And what do you see? Bitcoin is a bet on a weaker dollar. There you go. So Bitcoin, in terms of support and resistance level, let's zoom out and let's get rid of Mr. Dollar here. And you can see that it is sitting pretty close to its prior all-time highs. It did bounce off that support level of 816, say 500, where we looked at before. It needs to break 20,600 to have that bull market breakout that many of you are excited for. If you're bullish on Bitcoin, well, guess what? You're bearish on the dollar. And I think for many people, that is probably pretty easy to do because everyone right now is indeed bearish on the dollar. Well, anyways, thanks for watching. We'll be back on Monday for the macro show. See you then. Bye now. The content of this video provides educational information only. Is not intended to provide investment or other advice. It is not to be construed as a recommendation or solicitation to buy or sell security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Stephen Van Meter, personal capacity, opinions expressed in video that I don't know do not reflect the view of Atlas Financial Advisors Inc. or Stephen Van Meter Financial.